1,000 tons. Just let that number sink in for a second. 1,000 tons. That is the absolutely staggering amount of physical gold that global central banks have been buying up, net, every single year since 2022. It's a completely unprecedented hoarding spree, and honestly, it is quietly reshaping the very foundation of global finance.
Welcome to The Explainer. Today, we're diving into a massive, ongoing structural shift in the global markets. We are demystifying the incredible rally we've seen in gold and silver, and more importantly, we're figuring out exactly where it's heading. We're pulling our insights today directly from two deeply researched reports by HDFC Securities and Ventura on the precious metals outlook for 2026. We're going to break down the exact macro drivers, uncover some hidden supply crises, and look at the concrete price targets they've laid out for us.
Here is our roadmap for today. We'll start with the precious metals boom, look at why gold still shines, and then jump into silver's hidden supply crisis. After that, we'll decode the gold-silver ratio, weigh the forecasts and potential risks, and wrap the whole thing up with their top ETF picks for 2026.
All right, Section 1, the precious metals boom. So we all saw these metals hit absolutely wild, unprecedented price levels recently, right? But the structural indicators in these reports suggest this isn't a fluke. It's locked in for the long haul. So what's actually driving this perfect storm? Well, analysts point to a massive confluence of macroeconomic tailwinds. First up, we've got a dovish pivot from the Federal Reserve and a general environment of falling yields. The crucial thing to understand here is that when interest rates and bond yields drop, the opportunity cost of holding a non-yielding asset like gold or silver drops right along with it. Suddenly, holding a chunk of metal that pays no interest looks incredibly attractive because the alternatives aren't paying much either. Add in the escalating geopolitical tensions and heightened volatility around global trade wars, and you get a massive surge in risk aversion. Investors, from massive institutions right down to everyday retail buyers, are flocking to the ultimate safe havens.
Moving into Section 2, why gold still shines.
You know, it really isn't just everyday investors buying up gold right now. The biggest financial players on the planet are quietly cornering the market. Get this, for the first time since 1996, foreign central banks actually hold more gold in their international reserves than U.S. treasuries. I mean, read that again. For over 2 decades, U.S. debt was the unquestioned king of global reserves, but not anymore. When you map this data out over time, the trend is undeniable. The line for gold holdings completely crosses over U.S. treasuries. Central banks are aggressively, and I mean aggressively, diversifying away from the U.S. dollar. Why? Well, they're trying to bulletproof their reserves against potential sanctions, which is a major lesson they've picked up from recent global conflicts, and they're hedging against sticky, persistent inflation. They're going back to a hard asset with zero counterparty risk, and that dynamic is putting a massive structural floor right under gold prices.
Which brings us to Section 3, silver's hidden supply crisis.
Now, while gold gets scooped up as the ultimate safe haven, silver is kind of the undervalued underdog here, and it's facing an absolutely intense physical squeeze. We're currently looking at 5 straight years of a global supply deficit in the silver market. The HDFC Securities report estimates that the cumulative deficit between 2021 and 2025 is going to hit nearly 800 million ounces. To put that into perspective for a second, an 800 million ounce shortfall is practically the equivalent of an entire year's worth of global mine supply just vanishing from the market. Demand is vastly outstripping what miners can pull out of the ground and what recyclers can scrape together.
So why is demand so incredibly high? Well, unlike gold, silver is an absolute must-have industrial metal. We're seeing record-high industrial demand right now, heavily driven by the boom in green energy tech and electronics. On top of that, the U.S. has officially slapped a critical mineral designation on it, and we're seeing actual export restrictions coming out of China. All of this is causing persistent, massive drawdowns in global silver inventories. The physical stock in major vaulting hubs like London and China is quite literally shrinking.
Let's jump to Section 4, the gold-silver ratio. If you're wondering which of these two metals actually has more runway left, there's a fascinating historical metric that analysts rely on. Let's just quickly demystify it. The gold-silver ratio is simply a tracking metric that tells us exactly how many ounces of silver it takes to buy 1 single ounce of gold. Historically speaking, analysts use a 50-to-1 ratio as the benchmark for a fair valuation between the two. When the ratio is above 50, silver is considered relatively cheap compared to gold. When it's below, it's considered expensive.
Right now, according to the data in the report, this ratio is sitting at approximately 57 to 1. So the big takeaway here is that silver still has some substantial upside potential just to catch up to its historical average against gold.
The analysts note that as this ratio compresses and naturally gravitates back toward that 50-to-1 benchmark, silver is perfectly positioned to significantly outshine gold. In fact, if gold just stays at its current elevated levels and that ratio drops down to 40-to-1, silver could easily blast right past the $110 mark.
Section 5. Forecasts and potential risks. Okay, so what does this actually look like in dollars and cents? Based on this incredible confluence of macro drivers and those huge supply deficits we talked about, the long-term outlook is incredibly bullish. For 2026, HDFC Securities has set their expectations for gold to target $5,108, stretching even up to $5,380. For silver, because of that severe physical squeeze and the ratio compression, the targets are highly aggressive. They're looking at $97, $103, and ultimately $115. The overarching strategy they recommend across the board is to use market dips to accumulate your long positions.
But let's keep it grounded. No analysis is really complete without looking at the potential risks. The reports impartially point out a very specific, short-term headwind for domestic prices in certain markets, particularly India. If the government announces import duty reductions on gold and silver in their upcoming budget, that could temporarily pressure local prices downward. It's absolutely vital to factor this into your timeline, but treat it as a potential short-term dip within a much broader, long-term structural bull market.
Finally, Section 6, Top ETF Picks for 2026.
So how do we actually translate all this big-picture macro theory into a concrete portfolio strategy? Well, the HDFC Securities Report gives us some very specific recommendations. For gold, they're highlighting the SBI Gold Exchange Traded Scheme. The recommended buying range they've outlined is between 117 and 119, with a target of 136 over a one-year time frame. For silver, if you want to capture that intense industrial upside we talked about, they point straight to the ICICI Prudential Silver ETF. That buying range is 240 to 246, with very strong upside targets of 285 and 300.
And just to be clear, these aren't just blind macro guesses. They're backed up by some rigorous technical analysis. The analysts note that these specific ETFs are forming higher tops and higher bottoms on both their weekly and monthly charts. They're sitting nicely above all their key moving averages, and momentum indicators like the MACD and the RSI are highly bullish. That confirms a sustained uptrend, backed by totally healthy market volumes. Basically, the technicals are aligning perfectly with the fundamentals.
Which brings us to the ultimate takeaway from all this research. Because of the undeniable central bank hoarding, the severe supply constraints, and the completely shifting macroeconomic winds, the official recommendation here is for investors to allocate up to 10% of their portfolio to precious metals, with the option to gradually scale that up based on your own personal risk appetite. So, knowing what you know now about this massive structural shift in the global economy, will you be allocating 10% of your portfolio to precious metals? It is definitely a question worth asking yourself as we gear up for 2026. Thanks so much for joining me on this explainer, and I'll catch you next time.